Okay, so you want to own a water company. No competitor down the street, no substitute product, and a customer base that legally cannot say no. Everyone in your territory needs water forever. It sounds like the ultimate monopoly. And in one very specific sense, it is. The catch is that governments knew exactly how good this deal looked a century ago. So almost everywhere in the world, they build a cage around it before letting private investors in. Here's how it actually works. In the U.S., water utilities operate as regulated monopolies. You don't set your own prices, a state public utility commission does. What you do control is your rate base, the pipes, treatment plants, and meters you've invested in. Every time you build new infrastructure, you ask the regulator to add that investment to your rate base, and in exchange, they let you earn an allowed return on it. Recently negotiated around 9.75% return on equity at America's largest water utility, American Water Works. That's the entire business model. Spend money on pipes, get a guaranteed return on that spending, repeat for 100 years. The company is planning $19 to $20 billion in capital investment between 2026 and 2030 alone, and management is guiding towards 7% to 9% annual growth in both earnings and dividends through 2030. Slow, boring, and remarkably steady, which is exactly the point. But here's the trap hiding inside that steadiness. Regulators cap your return, but they don't cap how you finance the assets earning that return. And debt is almost always cheaper than equity. So the more leveraged you get, the higher your return on equity looks, right up until it doesn't. Nowhere shows this better than Thames Water, Britain's largest water utility, serving 16 million people across London and the southeast. After privatization in 1989, its owners loaded the company with debt while extracting billions in dividends. UK water companies paid out £50.6 billion in dividends between 1991 and 2021, leaving the pipes underinvested and the balance sheet fragile. By 2025, that debt pile had climbed to around £18 billion, and the company was warning that collapse into a special administration, essentially temporary nationalization, could occur in the very near term if it couldn't strike a deal with lenders. Private equity giant KKR had been lined up as a rescue investor, but KKR walked away from the deal entirely in June 2025, spooked by the sheer scale of the debt and regulatory risk. Thames avoided immediate collapse only after securing court approval for a £3 billion emergency loan in early 2025, an eye-watering interest rate of 9.75% a year, the exact same number American Water Works earns as its allowed return on equity. One company earns that rate. The other has to pay it just to survive. Regulators eventually allowed Thames to raise customer bills by 31%, and by late 2025, the company reported a £414 million profit, up sharply from a loss the year before. But even with that turnaround, management admitted the debt overhang was still severe enough that collapse remained on the table. Now compare that to American Water Works over the same stretch. Same regulated monopoly structure, same guaranteed return mechanics. But instead of loading up on debt and paying it out to shareholders, American Water financed its growth with a disciplined mix. Roughly $12.5 billion of debt, alongside $2.5 billion of new equity issuance in its latest 5-year plan, keeping leverage in a range its regulators and credit rating agencies consider safe. The result, steady rate case wins like California and Virginia settlements, adding tens of millions in new annual revenue tied to real infrastructure investment, and 2025 adjusted earnings per share of $5.64, up from $5.18 the year before. Quiet, compounding growth with none of the collapse headlines. Same regulated monopoly, same guaranteed return. One company treated the debt ceiling as a target, the other treated it as a limit. So if you do decide to buy a water company, understand what you're actually buying. You're not buying a business that competes for customers. You're buying the right to earn a fixed, regulated return on every dollar you responsibly invest in the pipes underneath the city. In the right hands, that's one of the most boring, dependable cash machines in the entire economy. The question is whether you treat the guaranteed return as the whole deal or as an invitation to borrow against a monopoly that everyone, eventually, has to pay for.